For 30 years, the 4% rule has been the holy grail of retirement planning. It was the gold standard, a simple promise that if you withdrew 4% of your portfolio every year, adjusted for inflation, your money would outlive you. But today, that rule isn't just outdated. Following it blindly could be the single biggest financial mistake you ever make. If you're planning to retire in 2026, the math that worked for your parents is now a recipe for running out of money. Today, we're breaking down why the 4% rule is officially dead, and more importantly, the dynamic guardrail strategy that smart investors are using instead to protect their nest egg. Back in 1994, financial planner William Bengen created the 4% rule based on historical data. At the time, bond yields were high, and the cost of living was predictable, but the world has changed. Point 1. The inflation monster. We aren't seeing the steady 2% inflation of the past, when your grocery bill, healthcare, and insurance premiums are spiking by double digits. A rigid 4% withdrawal doesn't just feel tight, it's unsustainable. Point 2. Sequence of returns risk. This is the silent killer. If the S&P 500 takes a hit in the first 2 years of your retirement, and you're still pulling out 4% plus inflation, your portfolio never gets the chance to recover. You're effectively selling your stocks at the bottom just to pay your bills. In the 90s, you could sit in safe government bonds and collect 6 or 7%. Today, even with recent rate hikes, real yields after inflation are barely scraping by. To get the growth you need, you're forced into more volatile equities, and volatility is the enemy of a fixed withdrawal rate. Modern research from Morningstar now suggests that a safe starting rate for a 30-year retirement is closer to 3.3%. That's a massive difference. On a $1 million portfolio, that's a $7,000 annual pay cut. So, if 4% is dead, what's the alternative? Enter the Guyton-Klinger Guardrail Method. Instead of a fixed percentage, you set rules of the road. Rule 1, the prosperity rule. If the market is up and your withdrawal rate drops below a certain point, say 3%, you give yourself a raise. You've earned it. Rule 2, the capital preservation rule. If the market crashes and your withdrawal rate spikes above 5%, you cut your spending by 10% for that year. This dynamic approach ensures you're never taking too much when the market is down, and you're maximizing your lifestyle when the market is booming. It's not about a fixed number, it's about flexibility. The biggest threat to your retirement isn't just the market, it's the fear of the unknown. When you follow a dead rule, every market dip feels like a crisis. But when you have a system that adapts, you stop worrying about the headlines. You know exactly when to spend more and exactly when to tighten the belt. Retirement shouldn't be a 30-year math problem you're afraid of failing. It should be the reward for 40 years of hard work. The 4% rule was a great starting point for a different era. But in 2026, you need a strategy built for volatility, not history. Are you still sticking to the 4% rule, or have you adjusted your withdrawal strategy for this economy? Drop a comment below. I'd love to hear how you're protecting your portfolio. And if you want to see the exact breakdown of the guardrail math, make sure to subscribe. We're deep diving into the tax-efficient withdrawal sequence in our next video. Thanks for watching. I'll see you in the next one.